Hi folks, this is Sean Hyman from Chart of the Day, and I just want to talk to you about high probability trade setups using moving averages. And two of the most common moving averages out there are the 50 period simple moving average, which is this black line, and the 200 period simple moving average, which is the purple line. And the slower moving average is the 200 period simple moving average, and it shows an overall longer trend, showing that the trend is basically down overall. The shorter moving average, which is kind of a medium term moving average really, with the 50 period SMA, shows the medium term trend. And so when the medium term trend goes under the long term trend, these can offer high probability trade setups. So one that I like to use, and I look for some of these sometimes in our currency cross trader service, is when the 50 goes under the 200, and then the price comes back to the first time when they're into the basic area where they've crossed. And so in other words, you have your cross here. This is where the 50 goes under the 200, so that's when you get on alert. And the price action's still down here. You wait for the price action to rally back up in the vicinity of the 50 SMA, and then that's where you would short and take the ride down. And you'll find, and I'm using this on a 4-hour chart. You can do this on daily charts or 4-hour charts. I typically would encourage you to use it on longer period time frames like 4 hours or daily charts, because those are going to be a lot more significant and have bigger potential moves. Okay, here you had your 50 cross above your 200 SMA. So the pair had rallied, and by the time it crosses, it pulls back, within the vicinity. This one's a little further off, but this pop-up that breaks out is the one that you would want to take. Let's look and see if we can find any more of them. Let's take a look at some other pairs here. And see if there's no cross, then we don't worry about it. Okay, on this one we get the cross over here, it comes down, and right in here and here are the first times that we get close to anywhere close to the moving average. So we can short in here. Now keep in mind, since we never know as the trade is unfolding and we don't know what's to occur ahead of time, when it comes close to anywhere within the vicinity of the 50 SMA, you can short, since we're in a downtrend here, and you'll need to have your stop a decent amount width above the SMA, but the long moves that can happen afterwards are what makes it a really nice trade setup. And the same thing here. You had this cross here, you had it pull back, and then this would be where you'd want to buy and ride it up. Now the thing is, people never know where a move is going to end, and so what you want to do once this gets notably in the profits, which like this bounced here, we'll call it here, and then it went up to basically about here. So that was from 91.88 to 93.25. So really once the trade gets up and moving a decent amount, you can move your stop up and capture a lot of this move, and then as the pair moves further away from your entry, you can move it up again. So you want to keep the stop far enough away from where the current market's trading, but also when you can remove risk to the trade, you want to do that as well. So there's another one. Let's see if we can find one more here. And keep in mind, if you don't have any crosses, that's okay. There are a couple of crosses there. Dollar CAD is usually not quite as clean. Here's another one. Let's see. Kiwi dollar crosses here. It takes a little bit before it comes back up. It rallies up to around here and has a pretty big sell-off. It does it again here. Now this one you could have gotten potentially stopped out if you tried it a second time. That's why I always stick with the first instance to where it rallies up a little closer. Let's look at some yen crosses. Here's Euro Yen 4-hour chart. It crosses here. Our first spike up is here, and then it slams down. Let's see if we've got anything on some other crosses. Here's pound yen. Here's probably the ideal situation, I would say, when you've got the cross and the pair rallies back up and collides with both moving averages. I think that offers you your greatest risk reward scenario. Will you get that every time? No, no, because when the trade is moving and the momentum is moving, many times you won't get a pair that moves all the way up back to the cross and then heads lower. However, this you could short anywhere right in here at the moving averages. Place your stop well above that, and the move that you'll get that unfolds afterwards is many-fold the amount that you're risking. So the closer it can get to that moving average, the better. Keep in mind too. Let's go back to one of these others that we were looking at with the cross where it didn't quite come down. If this comes down and starts planing out, this is a slowing down of the downward momentum. So that's one key that you're probably not going to make it all the way down to here when this thing's already trying to make a turn. But you can always keep a buy entry a little above the market too as another strategy. That way, if you start to miss it and it pops up on you, you get triggered into your order that's already been sitting there waiting for you and heading up as well. So there's a few different ways you can do these types of things, but the main point of it is look for the 50 and 200 SMA crossovers, then look for the pullback towards towards those moving averages. Many times it's not going to come back and actually hit the actual moving average because the momentum is so much there. And that's okay. Many times when it doesn't pull back and hit a moving average, that's almost even a sign of a stronger trend because the market, the people in the market are going in there and buying it up far sooner than it actually coming down and hitting this. So you can have some pretty sizable moves that happen after times like that. So that's okay. Don't feel that you won't have much potential, because in those times where it doesn't come back to your SMA, like I say, even though your stop's got to be back here, look at the distance between here and here, and then look at the distance between here, and what this ended up doing. So there's huge amounts of potential. They're lower risk, higher probability trades right after the trend changes and the near to medium term moving average crosses over the longer term moving average. So that's your 50 SMA and your 200 SMA. And like I say, we look for a lot of these types of things. A lot of these technical levels and approaches in the Currency Cross Trader service. If you've never checked that out, I'd encourage you to call Sarah or Jesse and some of the other ones on our customer service team, and they'll be glad to talk to you about it and to tell you more about the Currency Cross Trader service. Remember, currency crosses are simply they're simply pairs that don't involve the dollar. And so they can be very beneficial because they trend more. Their interest rate differentials are wider, which makes them trend more and longer, more potential for a number of pips, and you get the benefit of being able to dodge a whole lot of dollar news data. So it's not that it won't move them any at all, but you don't get shaken out of a trade nearly as easily on a currency cross trade as you do on a dollar trade. Hey, thanks so much for watching. Bye-bye.